You saw gold at $5,110 and thought this was just another headline rally. That's the mistake. Because the real story isn't gold up. The real story is that multiple parts of the system are sending signals that should not coexist. Gold above $5,000, silver near $110. Japan's 40-year yield around 4.1%. USD JPY still near 154. DXY sliding toward 97. That mix shouldn't be stable. It shouldn't even be possible. In a normal market, high yields punish metals. A weaker dollar supports metals, yes, but not like this. Not with yields still heavy and Japan's long end breaking. In a normal market, a bond shock in Japan forces the currency to move first. Carry trades unwind, FX spikes, the yen rips higher, liquidity vanishes, then everything else adjusts. But look at what we have instead. Rates are screaming in the long end and FX is barely reacting. Metals are grinding higher and nobody looks excited. The dollar is weakening and risk assets are not acting like they're celebrating. This shouldn't be happening. DXY down roughly 3% in a short window would normally come with a clear risk-on narrative. You'd see credit spreads tighten. You'd see volatility compress. You'd see equities act like the coast is clear. That's not what's on the screen. You have a softer dollar without relief. You have higher yields without discipline. You have stronger metals without mania. That combination doesn't signal confidence. It signals that the market is no longer trusting its own pricing mechanism. And when trust drops, markets don't always crash immediately. Sometimes they do something more dangerous. They go quiet. Gold above $5,100 is not being driven by some euphoric wave of buyers. It's being driven by the absence of sellers. That difference is everything. When sellers vanish, you don't get a clean price. You get a thin price. And thin prices don't move smoothly. They jump. Silver near $110 is even more revealing, because silver usually needs either true demand or true speculation. Instead, what you're seeing looks like positioning that refuses to unwind. A market that won't give you supply at the old price. That's not bullish enthusiasm. That's stress hiding in plain sight. Now zoom into Japan, because the long end of Japan is where global duration risk gets exposed first. Japan's 40-year yield pressing 4.1% is not a local issue. Japan is not a small corner of the system. Japan has been one of the anchors. When that anchor moves, it drags global pricing with it. For years, Japan exported capital. Low domestic yields, stable policy, predictable funding. That created the fuel for carry trades. Borrow cheap, buy higher yielding assets elsewhere, harvest the spread. That machine only works when long end volatility stays contained. But now the long end is moving, and it's moving fast. A rise of 60 plus BPS in the long end over a compressed period is not noise, it's repricing. It's the system admitting that duration is risk again. In a normal world, that repricing would trigger immediate position closures. You'd see USD JPY break hard. You'd see safe haven flows slam into the yen. You'd see forced selling ripple through bonds, equities, and credit. Instead, USD JPY sits near 154 like nothing happened. That is not reassurance. That is delay. It tells you positions are still open. It tells you exits are not being taken yet. It tells you the crowd is still assuming they'll be able to leave later. And that's what creates the trap. Because when everyone plans to exit later, there is no later. There's only the moment liquidity disappears and the market gaps. Now connect that to US rates. US 10-year yields around 4.3% should be enough to cool everything down. They should tighten conditions. They should support the dollar. They should lean on gold, but gold is not leaning. Gold is not obeying. That's the point. When a core relationship breaks, it rarely breaks for no reason. It breaks when the market starts pricing something that policy can't easily fix. You can't talk a bond market into stability if buyers don't trust the future. You can't talk a currency into strength if fiscal math looks unstable. You can't talk metals down if the real issue is credibility, and credibility is exactly what's being tested. Gold up roughly 18% year-to-date while yields remain elevated is not normal inflation hedging. It's a vote against confidence. It's a vote against policy control. It's a hedge against a system that looks stable on the surface and fragile underneath. Silver holding near $110 while global yields stay heavy is the same message, just louder. Because silver is the metal that usually gets punished first when liquidity tightens. If silver's not breaking, it means something else is absorbing the stress. And that something else is the market's willingness to pretend everything is fine. Here's the real contradiction you need to sit with. Rates are high, yet the dollar is weak. Metals are strong. FX is calm. That is not equilibrium. That is the market pausing price discovery. Because the market doesn't know what the true price is anymore. Not of risk, not of duration, not of currency hedges. When that happens, the first phase is not chaos. It's quiet. The second phase is violent repricing. And you never get a warning between those phases. You only get a gap. So if you're watching this like it's a normal rally, you're already late. Because this isn't a rally story, it's a structure story. The structure is sending one message. The system is losing its ability to clear price smoothly. The dollar is drifting lower, not collapsing, because this isn't a panic event yet. It's a confidence leak, a slow leak. The kind that doesn't look urgent until the floor gives way. And the floor gives way when the market finally reacts the way it was supposed to react days or weeks earlier. That's what makes this setup dangerous, not because it's loud, because it's quiet. Now let's go deeper into Japan, because this is where most investors are still dangerously complacent. Japan is not just another bond market. It's one of the structural pillars of the global financial system. For decades, Japan provided cheap funding to the world. Zero rates, controlled yields, predictable policy. That environment created the carry trade machine. Borrow yen at near 0%. Buy US bonds yielding 4%. Buy European credit yielding 5%. Buy anything that offered spread. That trade worked as long as one thing stayed stable. The long end of the Japanese yield curve. Now that stability is gone, Japan's 40-year government bond yield pushing above 4.1% is not a technical breakout. It's a regime change. A move of more than 60 basis points in the long end over a short period is not adjustment. It's repricing risk that was never supposed to exist in Japan. In a normal environment, this would force immediate consequences. Japanese institutions would start repatriating capital. Carry positions would unwind. The yen would strengthen sharply. But that isn't happening yet. USD JPY is still hovering around 154, down barely 2% from recent highs. That tells you something critical. Positions are still open. Large funds have not exited. Pension money has not rushed home. The system is still assuming that liquidity will be there when needed. That assumption is fragile. Japan holds well over $1 trillion in foreign assets. Even a 5% shift in allocation is not small. That's tens of billions of dollars moving across borders. If that flow reverses quickly, U.S. Treasury demand feels it first. European bonds feel it second. FX markets feel it immediately. And yet markets are behaving as if this risk is theoretical. It's not. The reason the yen hasn't moved yet is not strength. It's delay. The market is still pricing a world where Japan remains a passive exporter of capital. But yields above 4% change the math. At some point, domestic Japanese yields become competitive. At some point, hedging costs outweigh foreign returns. At some point, the carry trade stops making sense. That point doesn't arrive smoothly. It arrives all at once. Now look at how this connects to metals. Gold holding above $5,100 while Japanese yields surge is a direct contradiction to the carry trade narrative. In a functioning system, rising yields increase the opportunity cost of holding gold. But gold is not responding to that pressure. Why? Because the issue is no longer yield. It's trust. When investors start questioning whether yields truly compensate for risk, they stop caring about opportunity cost. Gold becomes a balance sheet hedge, not a trade. Silver near $110 reinforces the message. Silver is more volatile, more sensitive to liquidity, more exposed to forced selling. If silver were truly driven by speculation, it would already be breaking. It isn't. That tells you stress is being absorbed elsewhere. Now bring the dollar back into the picture. The dollar index drifting toward 97, down roughly 3%, should normally provide relief. Emerging markets should rally. Risk assets should breathe. Instead, the reaction is muted. That's because this is not a growth optimism dollar move. It's a confidence erosion move. The dollar is weakening because global capital is diversifying away from policy risk, not because investors are suddenly optimistic. That distinction matters. When the dollar weakens on optimism, volatility falls. When it weakens on doubt, volatility is delayed. Delayed volatility is the most dangerous kind because it lulls positioning into complacency. Now think about bonds. U.S. 10-year yields near 4.3% are not benign. At these levels, debt servicing costs escalate quickly. Every 100 basis point increase adds hundreds of billions in interest expense over time. That's not political, that's arithmetic. Markets know this. That's why bonds are not being bought aggressively. That's why yields stay elevated. And that's why gold refuses to sell off. The system is stuck between two outcomes. Either growth slows enough to pull yields down, or confidence breaks and forces a repricing. What's not happening is the soft landing the market keeps pricing. And the longer prices stall in this contradictory configuration, so the more violent the eventual adjustment becomes. This is the phase where nothing seems urgent, where charts move sideways, where commentators say the market is digesting. But digestion doesn't last forever. At some point, something gives, and when it does, it won't start in headlines. It will start in liquidity. That's why watching Japan matters. That's why watching the yen matters. That's why watching gold and silver together matters. They're not telling you the same story as equities. They're telling you the story underneath, a story of delayed reaction, of positions still open, of exits assumed but not taken. This is how systems fail, not because everyone is wrong, but because everyone waits too long to act. And by the time they do, the price is no longer available. Now let's pull the Federal Reserve and geopolitics into this, because this is where the contradiction deepens. Officially, the Fed tells you policy is restrictive, rates are high, inflation is moderating, the job is almost done. If that were true, markets would look very different. With policy rates above 5%, long-term yields near 4.3%, and real yields still positive by roughly 2%, the system should be tightening everywhere. Liquidity should be draining. Speculation should be punished. Safe assets should outperform risk. But that's not the full picture you're seeing. Gold above $5 to $100 says policy credibility is being questioned. Silver near $110 says liquidity stress is being redirected, not resolved. And a weaker dollar with high yield says global capital is hedging against policy error. That combination does not happen in a confident system. Look at fiscal reality. The U.S. is running deficits north of 6% of GDP. Debt issuance is massive. Treasury supply keeps rising even as foreign participation weakens. At the same time, geopolitical risk hasn't disappeared. Trade fragmentation continues. Energy routes remain vulnerable, and defense spending is structurally higher than it was 5 years ago. Markets are supposed to price this. Normally, higher geopolitical risk strengthens the dollar. Normally, higher deficits pressure bonds. Normally, tighter policy crushes metals. But again, that's not what's happening. The dollar weakens instead of strengthening. Bonds struggle to rally despite risk. Metals rise quietly without panic. This shouldn't be happening. The reason is simple but uncomfortable. Markets are no longer pricing a single future. They are pricing multiple unstable paths at the same time. One path says growth slows, inflation falls, and yields eventually decline. Another path says fiscal dominance takes over, inflation returns, and yields spike. A third path says confidence breaks. Before either of those outcomes fully materializes, when markets can't agree on which future to price, they hedge. Gold is the hedge against policy credibility. Silver is the hedge against liquidity disruption. A weaker dollar is the hedge against concentration risk. This is not about being bullish or bearish. It's about being unsure, and uncertainty is expensive. Now look at volatility. Equity volatility remains compressed. Bond volatility is elevated but controlled. FX volatility is oddly subdued. That divergence is another warning. In stable environments, volatility moves together. In unstable environments, it fragments. Fragmented volatility means markets are disagreeing internally. Some parts are bracing for impact. Others are pretending nothing is wrong. That internal disagreement is where crashes are born. Because when one side is forced to concede, the adjustment is sudden. Now consider positioning. Many funds are still positioned for a world where carry trades survive, where liquidity is available, where exits can be staged over days or weeks. That assumption worked when central banks suppressed volatility. It fails when volatility is delayed rather than eliminated. Delayed volatility is worse than immediate volatility. It compresses risk into a smaller window. Think back to previous cycles. Crises rarely start when everyone is panicking. They start when people are comfortable, when volatility is low, when narratives sound reasonable. By the time fear shows up, positioning is already wrong. That's where we are now. Gold is telling you something is off. Silver is confirming it. The dollar is quietly agreeing. Japan's yield curve is flashing red, but equities are still pretending this is manageable. That disconnect doesn't last. Either equities reprice lower, or bonds reprice higher, or currencies move violently. One of those has to give, and when it does, it will feel sudden. But it won't be random. It will be the release of pressure that has been building while markets stayed quiet. This is why the current calm is dangerous, not because disaster is guaranteed, but because the system is positioned as if adjustment can be smooth. History says it won't be. The longer markets ignore incompatible signals, the more violent the resolution becomes. That's not opinion, that's structure. We're in the phase where prices look stable, but relationships are broken. And broken relationships don't heal themselves, they snap. If you're watching gold, silver, the dollar, and bonds separately, you'll miss it. You have to watch them together. Because together, they're telling you something the headlines aren't. The system is no longer pricing risk cleanly. And when price discovery fails, markets don't glide. They gap. Now step back and look at the full structure, because this is where the picture becomes uncomfortable. What you're seeing is not a normal cycle. It's not a clean transition from tightening to easing. It's not a simple risk-on or risk-off environment. It's a market caught between credibility and arithmetic. Rates are high. Yields are elevated. Debt levels are extreme. And policy room is limited. Those four facts cannot coexist peacefully forever. Gold above $5 to $100 is not a vote for inflation. It's a vote against certainty. Silver near $110 is not an industrial boom story. It's a liquidity warning. The dollar drifting lower toward 97 on the DXY is not confidence in growth. It's diversification away from concentration risk. And Japan's 40-year yield above 4.1% is not a local anomaly. It's the signal that the global anchor is moving. When anchors move, ships don't adjust slowly, they lurch. This is where the idea of normalization breaks down. Markets keep waiting for confirmation, for the Fed to say something new, for inflation to print one more number, for geopolitics to calm down. But the problem isn't information, it's structure. You cannot run deficits above 6% of GDP indefinitely with yields near 4 to 5% and expect no consequences. You cannot roll trillions in debt without buyer fatigue. You cannot rely on foreign demand while weakening your currency. At some point, something has to absorb the pressure. Historically, that pressure goes one of three places: into currencies, into inflation, or into financial instability. Right now, the market is trying to spread it across all three. That's why nothing looks extreme, and that's why everything feels off. This is the phase where risk doesn't look urgent, where portfolios don't feel threatened, where commentators say the system is adjusting, but systems don't adjust forever. They resolve. Resolution doesn't come with advance notice. It comes when one market finally reacts the way it should have reacted earlier. That's why the silence matters. When gold rises loudly, everyone notices. When it rises quietly, people dismiss it. When bonds sell off violently, it's obvious. When they drift higher in yield while buyers disappear, it's ignored. When currencies crash, it's panic. When they stall while fundamentals deteriorate, it's denial. Denial is the most expensive phase because it encourages leverage. It encourages patience where urgency is required. It encourages the belief that exits will always be available. They aren't. Liquidity is not a constant. It's a condition, and conditions change faster than people expect. When markets finally agree on which future to price, they don't negotiate. They jump. That's why the most important signal right now is not volatility. It's correlation breakdown. Gold up, yields up, dollar down, FX calm. Those relationships should not coexist. And when they stop coexisting, the move will not be incremental. It will feel sudden. This is why waiting for confirmation is dangerous. By the time confirmation arrives, the adjustment is already priced. Markets don't reward the last person to understand the risk. They punish them. This isn't a call to panic. It's a warning against complacency. Because complacency assumes tomorrow looks like today, and today's configuration is unstable. The real risk is not missing a rally. It's being positioned for calm in a system that is quietly losing balance. Gold, silver, the dollar, and bonds are not sending mixed signals. They are sending one message from different angles. The message is that the system is under stress, but not enough people are reacting yet. That's the window where mistakes are made. When the reaction finally comes, it won't ask who was paying attention. It won't wait for consensus. It will move. And after it moves, the explanations will sound obvious. They always do. But explanations come after price. And by then, the silence will be gone, along with the opportunity to act.